You know, the stock market can often feel like this exclusive club with its own secret language, full of jargon that's designed to keep people out. But what if we could just pull back the curtain and see how it really works, piece by piece? Well, that's exactly what we're about to do. It really all starts with a story. It's the journey of a business, from just a little spark of an idea all the way to becoming a massive company that's traded by millions of people every single day. That transformation, that's the real heart of the stock market. And we're going to follow it right from the very beginning. So, here's our roadmap for today. We're going to start with how a company is born into the market. Then we'll look at where it's traded, the tools you use, how to get a feel for the market's mood, two totally different strategies for making decisions, and then, finally, where you might fit into this whole picture.
Okay, so let's get started. Our journey doesn't begin on a loud, chaotic trading floor. Nope, it begins quietly with an entrepreneur, maybe in a garage or a coffee shop. Before a single share can ever be traded, a business has to be born, and it has to grow up.
Think of it like leveling up in a game. First, a founder has a brilliant idea, but ideas need money to grow, so they get a seed fund to get things started. As the business takes off, it needs more fuel, a lot more. That's where venture capital comes in. And then, for the really big leagues, for massive expansion, the company decides to go public through an IPO.
Now that first stage is so important. It's powered by people called angel investors. And it's the perfect name, right? Because they're providing that crucial first bit of cash, the seed fund, when the idea is at its most fragile. They are literally betting on a dream, taking on a huge amount of risk for a piece of the company, all in the hope that it becomes the next big thing.
And all of this growth, all this funding, it leads to the big moment, the IPO. The initial public offer. This is the main event. It's the critical point where a private company opens its doors and offers its shares to the public, to you, to me, to anyone. It is their very first time doing this, which is why we call it the initial offer.
Okay, so the company has its IPO. The shares are out there. But where do they actually live and get traded? This is super important to understand because there isn't just one stock market. There are actually two completely different markets that work together.
All right, here's the fundamental difference. The primary market is basically a one-time event. During the IPO, the company creates and sells brand new shares directly to the first investors. All that money, it goes straight to the company so it can grow. After that, everything else happens in the secondary market. That's where all of us investors just trade those existing shares among ourselves.
Let me just repeat that because it's the most crucial takeaway here. The company gets its money just once from the primary market. Every other transaction you see on the news, the stock price going up and down every day, that's all happening in the secondary market, and the company isn't getting a dime from those trades.
So, how do you and I actually get into the secondary market to buy and sell stocks? Well, you need a gateway. You need a door. And that door comes in the form of a special piece of software that is your personal window into the entire stock exchange. Every investor starts their day right here with a secure login. The software your broker gives you is called a trading terminal. Just think of it as your own personal, super secure portal to the markets. The second you log in, you are connected directly to the exchange, and you can see live prices, and you're ready to place orders. Now, once you're in, one of your best friends is the order book. It's exactly what it sounds like. It's your personal logbook of every single transaction. When you tell it to buy or sell a stock, that order gets logged right here. It shows you if your order is still waiting, if it's been completed, or maybe if it was rejected. It's basically your command center. And while you're looking at your screen, what is the stock exchange itself actually doing? Well, behind the scenes, it's running this massive, high-speed game of matchmaker. Its one and only job is to take your buy order and instantly find someone somewhere out there who placed a sell order for the exact same price, and then, bam, make the trade happen.
All right, so now we know how to place a trade. But with literally thousands of companies out there, how can you possibly know how the market is doing overall? Like, is it a good day or a bad day for the economy? That is where market indices come in. An index is basically a cheat sheet for the market's health. Instead of trying to track thousands of different stocks at once, which is impossible, an index just bundles together a hand-picked group of the biggest and most important companies. If the value of that bundle is going up, it's a pretty good sign that the whole market is feeling optimistic. This is the absolute perfect metaphor. Seriously. A barometer measures air pressure to predict the weather, right? Well, a stock market index measures investor sentiment. You could call it the financial pressure. When the index rises, it's signaling optimism and confidence. When it falls, it's a sign of pessimism and fear about what's coming. To make this more concrete, let's just take India as an example. You'll constantly hear about two main indices there,
the Sensex, which tracks the top 30 companies on the Bombay Stock Exchange, and the Nifty 50, which tracks the top 50 on the National Stock Exchange. These two are really the primary economic barometers for the whole country.
Okay, now we're getting somewhere. We know how to read the market's mood, but how do we decide what specific stock to buy or sell? Well, this leads us to one of the biggest debates in the entire investing world. It's centered on two completely different philosophies for making a decision.
So, on one side, you have fundamental analysis. Think of these people as detectives. They're investigating the company itself, its earnings, its debt, its management, the whole economy, all to figure out what the company is truly worth. Then, on the other side, you have technical analysis. These folks are more like meteorologists. They pretty much ignore the why and instead just study price charts and market data to predict future price movements based on past patterns.
And if we want to boil it down even more simply, it all comes down to two very different questions. Fundamental analysis is trying to answer, is this a good company to own for the long haul? And technical analysis is asking, is right now a good time to buy or sell it? One is all about quality, the other is all about timing.
So we've covered the whole journey of a company, the markets it lives in, the tools we use, and the strategies for analyzing it all. The very last step is to think about how all these pieces fit together to define your own approach to the market.
See, your preferred philosophy usually points you down one of these two paths. Long-term investors, they almost always use fundamental analysis. Their goal is simple: buy a piece of a great business and hold on to it for years, just letting it grow. Short-term traders, on the other hand, they tend to rely on technical analysis. They're trying to profit from those price swings that can happen in a day, a week, or maybe a month.
But here's the most important thing to remember. There is no single right answer here. The real questions are for you. What are your goals? Are you trying to build wealth for retirement in 30 years? Or are you trying to generate some income this month? How much risk are you really comfortable with? The best strategy is always the one that fits your own goals and your own personality.
Wow, we've gone from a simple idea all the way to the complex world of trading and analysis. We've seen how companies are born into the market and how millions of investors decide what they're worth every day. So, the final question isn't for me to answer. It's really for you to think about. Now that you know all this, what path might you choose?